Hello. In this episode, I'm going to introduce you to the analyzing and recording process in the recording transactions into the accounting system. Recall when a business transaction occurs. That business transaction and its financial impacts on the company need to be recorded into the accounting system. This is accomplished by first identifying that a transaction occurred, and that is done from source documents. Source documents are things such as an invoice received in the mail from the purchase of supplies, or a utility expense bill from the utility company, or a bill of sale from the sale to a customer. Once a transaction is identified, the transaction is then recorded into the accounting system through an entry in a journal. We call this the general journal, and you can think of it as the original book of entry into the accounting system. When an entry, which we call a journal entry, is entered into the general journal, it is the first time that the accounting system becomes aware that a transaction occurred. Once the entry is in the general journal, we then would transfer the journal entry and its impact on the different assets, liabilities, and equity accounts of the company into the general ledger. The general ledger is where we keep track of all the different types of assets, liabilities, and equity accounts that a company uses. And finally, to ensure that the journal entries were properly transferred to all the account records, we would prepare a trial balance. A trial balance is simply, think of it as a little worksheet, spreadsheet, that ensures that all of our accounts are balanced. So let's talk about a couple terms that I've used. An account. An account is just simply a record of increases and decreases to a specific asset, liability, equity, revenue, or an expense item. When a business transaction occurs, it will affect one type of asset or a liability or an equity or revenue or an expense, and at the same time it will also impact another asset, liability, equity, revenue, or expense. And we keep track of all of these different types of elements in a separate account. We keep track of all accounts in a general ledger, and a general ledger is a record that contains all accounts that are used by a given company. Think of the general ledger as a filing cabinet. Within that filing cabinet, we have an asset drawer with all of the accounts for the asset. In the liability drawer, we have records of each type of liability that a company currently has. And in the equity drawer, we have a record of all of the different types of equity, revenue, and expense items. Recall that the basic accounting equation, a company's assets, will always equal its total liabilities plus the owner's equity. Owner's equity is comprised of four main elements: common stock, or the amount of owner investments; revenues and expenses, or a measure of the company's profitability, and any amount of those profits that have been paid to the owners in the form of dividends. As owners invest, equity goes up. As revenues are earned, equity goes up. As expenses are incurred, equity decreases. And as dividends are paid, equity decreases. I mentioned a few minutes ago that the general ledger, the filing cabinet, is the records of all accounts used by a company within its accounting system. So here's an example of what a chart of accounts, or a list of all accounts that is used in a company. This is an example of what it might look like. So we can see here that each type of asset is maintained in a separate account because we want to keep track of how much cash, how much accounts receivable, how much supplies, how much prepaid insurance, and how much equipment a company has. We also keep track of liabilities separately, and we keep track of all of the different equity accounts separately as well. Notice that each account has a name and it has a unique number assigned to it. We always use both numerical and non-numerical names to make it easier for the software to track account numbers and make it easier for individuals to identify accounts by name.